Hello guys, welcome back once again to the Financial Academy YouTube channel. Yes, of course. Welcome back once again to the Financial Academy YouTube channel. So in today's video episode, I'm going to be teaching you how to make use of the support and resistance in the Forex trading. Yes, of course. So basically it's all about how to trade the support and resistance successfully in the Forex trading. So please, if this video is for you, please make sure, and if you like my videos, make sure to like this video, make sure to subscribe to my YouTube channel, and also comment down below if you have any single question concerning any of my videos, because in today's video episode I'll be able to break down for you how to make use of support and resistance successfully and consistently in the forex market. Are you getting me? So follow me right now. I will take you to my screen. When I take you to my screen, I'll be able to break down everything for you and every information that you need to know on how to trade the support and resistance. Also, if you are seeing me for the first time, I create content concerning the forex market, the stock market, and the cryptocurrency market. Everything concerning the financial market. This channel is for you. Make sure to stick with me and watch this video from the beginning to the end. Right now, let's go to my screen. Let me break down today's topic for you. Let's go. Let's go. Let's go. Let's go.
Hello guys, welcome back to my screen. So let's continue. Mastering support and resistance, the trader's guide to forex market dynamics. Yes, of course. So in this context, I want to be telling you everything you need to know about mastering, support and resistance. So which is the foundation of price action. Yes, I give it the foundation of price action. Let's continue. In the vast scrolling ocean of the forex market, where trillions of dollars exchange hands daily, traders are consistently searching for a reliable navigational tools. Among the most fundamental and powerful of these tools are support and resistance levels. Unlike complex indicators that lag behind price, support and resistance represent the collective psychology of the market. Sorry for that. Collective psychology of the market. The ongoing battle between the buyers and sellers. Understanding how to identify and use this level is not just a skill, it is a cornerstone for successful price action trading. In this video, we will take you from the absolute basis to the advanced application, giving you the confidence to use this concept in your strategy very well when you are trading. So right now, let's continue with chapter 1 or number 1. What are support and resistance? So number 1, let's continue. At this core, support is a price level where buying interest is sufficiently strong to overcome selling pressure. Think of it as a floor under the price where demand steps in, preventing the price from falling further. Visually, it is a level where a declining price halts and bounces. What are resistance? Resistance is the opposite. It is a price level where selling interest overcome buying pressure, acting as a ceiling that the price struggles to break through. It is where a rising price stalls and reverses. You need to ask yourself, why do support exist? Why do resistance exist? Let me break it down for you. These levels form due to market memory. Traders remember where prices previously reversed. If price falls to a certain level and then rallies, market participants, both those who bought and both those who missed the move, will be inclined to buy again at that level. This same psychology works in reverse for resistance, because what works in support is the opposite of what is working in the resistance. Number 2, this is chapter 2. How to correctly identify support and resistance. Are you getting me? A common mistake for beginners is seeing potential level everywhere. But here is how to identify significant levels of support and resistance. Number 1 is this. Look for touch or reversal point. Yes, the more times at a price have touched and reversed from a specific level, the stronger and more significant that level becomes. A level tested 3 to 5 times is far more meaningful than one touch that one touch only once. Are you getting me? Number 2, prior swing high and swing low. On any chart, identify the clearest peak, which is swing high, and trough, which is swing low. These are your primary resistance and support zone. Number 3 is strength is relative. The strength of a level is determined by frequency of test. More touches equals to stronger level. The other one is time frame. A level that has held on a weekly or daily chart is exponentially stronger than one on a 15-minute chart. Are you getting me? Then the other one is sharpness of rejection. Did the price reverse violently? A strong pin bar or engulfing candle, or just slowly green against the level? A sharp rejection shows stronger conviction. So number 4 is zones and not line. In Forex, the more accurate to think of support and resistance zone is rather than precise line. So the best way to think of support and resistance is zone, because prices often react within a small band or area. Draw your level as horizontal band on your chart to capture this zone. Number 3, or chapter 3, they call trading application. Number 1 is trading the bounce or range band markets. In a market without a clear trend, price oscillates between the clear support and resistance. What are the strategies you need to follow? Number 1 is buy near the identified support zone. Place a stop loss just below it. Sell or take profit near the identified resistance zone. Now, what are the mindset you need to have when trading the bounce? You are trading the assumption that the historical price range will hold. Are you getting me now? So these are the mindset you need to have when trading the bounce. You are trading the assumption that the historical price range will hold. Number 2 is trading the breakout, which is trending market. Now, when price consolidates, it often builds energy for its next move. A decisive break of a key level can signal the start of a new trend leg. Now, what is the strategy you need to follow? Which is enter a long position when the price closes above a significant resistance level with momentum. Example is this: a strong bullish candle. The other one is place a stop loss below the broken resistance, which is now becomes a support. What are the caution you need to take? False breakouts are common. Wait for a confirmed close beyond the level and look for increased volume if your platform shows it. Number 3 is the role reversal phenomenon. This is a critical concept. When a strong resistance level is decisively broken, it often flips and shows you support in a bullish trend. Conversely, when strong support is broken, it can become a new resistance in bearish trend. Then what are the strategies? This offer high probability entry point after a breakout. Look for price to retrace back to the old resistance turn support. Level to buy. This is often called a retest or a backtest. So the rule reversal phenomenon, the strategy you need to have is that it offers a high probability entry point after a breakout. But what you need to do is that you need to look for price to retrace back to the old resistance turn support, which is the level to buy. And then this is often called a retest or a backtest. Then chapter 4, number 4 is combining with other tools for a higher probability trade. Support and resistance are powerful alone, but they become incredibly potent when combined with other forms of confluences. What are these confluences? Number one is trend line. Do your horizontal support or resistance zone. Do your support horizontal and resistance zone align with diagonal trend line or support or resistance? This creates a powerful confluence area. Number two is Fibonacci retracement. Key Fibonacci level, especially 38.2%, 50%, and 61.8%, often align with a major horizontal support zone in a high quality setup. Candlestick pattern. Look for a reversal candlestick pattern like pin bar, engulfing pattern, doji at your key support or resistance zone. This pinpoint the exact moment sentiment shift. Then number four is moving averages. Major moving averages like the 50, 100 or 200 period EMA often act as a dynamic resistance or support where they intercept with horizontal level. Pay attention. Then number five is common pitfalls and how to avoid them. Number one is this: overcomplicating the chart. Yes, don't draw levels at every minor peak and troughs. No, focus on the most obvious multi-touch levels on the higher time frame. Number two is trading against the trend. Be cautious about taking a bounce trade as support in a strong trend. The trend is your friend. It is often safer to trade bounces in a range or breakouts in the direction of the trend. Number three is this: ignoring higher time frame. These are the common mistake. Always check where your level sits on the next higher time frame. Example: if you are trading on 1 hour, check the 4 hour and the daily. A level on the daily chart will always trump a level on the 1 hour chart. Number four is placing stop loss too tight. If you place your stop loss right at the support or resistance level or the support and resistance line, you risk being taken out of the market, noise or weak beyond the level. Before the level is truly broken, you give a trade a little room to breathe just beyond the zone. So this thing is trying to explain that these are the common pits for you to avoid and how to avoid them. One is overcomplicating the charts. Number two is trading against the trend. Always follow the trend. Number three is ignoring higher time frame. Always analyze the market from the higher time frame to the lower time frame. That is what it is called top-down analysis. From the monthly down to the weekly, down to the daily, down to the 4 hour and the 1 hour chart. Minimum I will stop analyzing is the 1 hour chart. Then also placing stop loss too tight. You need to place your stop loss away from the market structure so that the market won't stop you out prematurely before taking you to your intended direction. I'm getting my point right now. So let's continue. In conclusion, the path to mastery. Support and resistance are not a crystal ball, but they are a map of the market's memory, and it is likely a future battleground. They transform a chaotic price chart into a structured story of supply and demand. Your action plan is this: 1. Observe. For the next week, don't trade. Just open your chart. Start with daily and 4 hour chart and mark every major support and resistance zone you see. Note how price interacts with them. That is the first thing. The first action you need to follow is paper trade. Use a demo account to practice trading the bounce and breakout at these levels. Adding one element of confluence at a time like a candlestick pattern is very, very good and more potent to giving you a higher probability entry. Then number three is integrate. Slowly incorporate this analysis into your existing strategy. Let the supports and resistance become the foundation upon which you place your entries, exits, and stops. Remember, mastery comes from screen time and consistent practice. By learning to read these key levels, you are learning to understand the language of the market itself. Happy trading And always remember to manage your risk. It is very, very important. In anything you are doing in trading, you need to have a proper risk management. Know and learn how to manage risk, because risk management will save you out from a whole lot of stress in trading. Avoid being greedy and also be disciplined in trading. Follow your trading plan and also control your emotion whenever you are in trading, because if you take too much risk, your emotion will be heightened. But if you take a small risk, you will be more relaxed and your mind will be settled when trading the forex market. So you need to have a proper risk management and learn how to control your psychology whenever you're in your market, and also have a trading plan. Because if you don't have a plan, that means you are bound to fail. Have a trading plan. Have a rule-based system that will guide you, that will help you to follow it religiously whenever you're in market. Because trading is a marathon and not a sprint. It is not a get-rich-quick scheme business. No. You need to take your time and learn it and trade it conservatively. Don't be aggressive. Don't be greedy. Be disciplined. And very soon you will start seeing more consistent result. You will like it. So if you have watched this video up to this moment, please make sure to give it a thumbs up button, like this video, subscribe to my YouTube channel, and share it to your loved ones. Comment down below if you have any single question concerning any of my videos here on YouTube. Thank you for sticking with me, and I will see you on my next video episode. Thank you, take care, stay safe, and bye.